Zhor says, I am a long-time investor and trader. My main strategy is selling cash secured puts. I would like to know how I can effectively use the premium I got. Buy more shares or just keep in cash for more efficiency. Oh, I think you wrote it twice, or it copied twice, okay? Okay, and you said to buy more shares or just keep in cash for more efficiency. Thank you. Okay, in general, my approach doesn't have to be your approach, and I don't have naked put there. So we must have done some bearish strategies the other day. Last time we were online together here. So let me add the naked put back in. There we go. And in general, whether it's a naked put or a cash secured put, we're selling an out of the money put, reasonable probability of expiring worthless, hoping to get the premium on the position. This is a monthly naked put search. In this case, that's why we're seeing 42, 43 days out in time. And that's perfectly fine. So in general, this is me personally. That's probably more conservative, less aggressive, and probably not as efficient. But if I entered one of these trades, let's just take Roblox at 115.89, and I'm going to sell the January 105 put for about 585. That's going to yield us a 5.7% return, roughly, in that case, against my margin requirement of 10,500. We're selling the 105, margin requirement cash secured 10,500. We're going to be taking in $595 per contract, or roughly 6%. This goes into my cash on hand. And although your portfolio is mostly made up of naked puts, I understand that. And you're seeing this cash roll in and this cash roll in. In general, for me, I typically don't use the new cash for any new positions. This is my new position. This is the position that I wanted. And I'm essentially going to leave this cash that was deposited alone right now in case I need it for management or adjustments. I don't want to spread myself too thin and start buying new shares, buying that and lowering my cash on hand in case something suddenly goes wrong. This goes down to 80, and now I'm finding myself having to buy this back for $2,500, $25 per contract, for example, and I need that capital to close this position before it gets further away from me. Unexpected events happen. I usually wait until expiration of the positions and then look to evaluate where my cash on hand stands, and that's cash I'm going to use to allocate to the new positions. If you've got a large cash on hand or in cash that you're keeping aside anyway for adjustments, maybe 15% of your portfolio, maybe 20% of your portfolio, and yes, what could I do here? I could take in this $595 here. Roblox is trading at 115. So yeah, I could maybe buy 4 contracts, that'd be 460, and I'd still have 130 left over if I was more bullish on the position rather than neutral to bullish. Absolutely. That is something you could consider. Would I sell a put, take the premium, and then buy a call against it? Well, maybe I'd buy one contract of something higher, maybe the 110 call. Now that'd still be more expensive. Maybe the 120 call is what I meant to say. Sort of out of the money, a lower price than 595. But that's speculative and dangerous, in my opinion. Buying the shares, I think, would be more preferable. Buying 3, 4 shares with this 595 premium if I just did one contract, sure. And the reason why I say buying the out of the money call would be speculative is because if the stock stays right where it is, that call expires worthless. I lost most of this 595 I've collected on a position that was still profitable if the stock's at 107, 108, or 109. But to buy that cheaper call with the same expiration, 120, maybe even the 125, I need a significant movement to get that back. I'm risking throwing this money away if I'm not right in that scenario. Okay. So as a general rule, if you've already allocated in your portfolio 20%, 10%, 15% of your available capital to use for management techniques or the oh no situation where one of the stocks suddenly falls and it costs a high amount for the naked put position, then you may be able to do that with the new premium that you took in if you are bullish on the stock. Now, you run the long call would be risky. Okay, buying the out of the money call with some of the premium, half the premium, this would be risky because you could be just throwing half of that premium away if you don't see the movements you want. Buying 3 or 4 shares could be risky as well. If I bought those 4 shares at 115 right now, so that would cost me, roughly 460, right, 462, $463, and the stock falls to 110. Well, I've lost $20 on those shares, still make the full 595, but I used most of that to put into the position. So now I'm in that slight situation there in that case where why didn't I look for just the full premium? I guess I'm a little bit more old school. If I entered this trade, this is the trade that I wanted there. Zhor, I'm going to wait till it expires before I count all my chickens that I profited 595 or 6% on this transaction, rather than try to put this right back into the market. As I said, that's probably a little bit more, that's probably on the conservative side. It's not as aggressive. And, in my 40s, I probably should be a little bit more aggressive, but I did a lot of that in my 30s for better and a lot of times for worse. So I don't tend to do that as much anymore. I would take the covered call premiums and then look to buy calls on other things. It didn't always work out for me, 10, 15 years ago. So I go back to just doing it the way that I like. Fernando adds that he used to protect the sold put with a put debit spread. He says he'd 1 OTM debit put spread and 2 -2 put more OTM. So I guess you're okay. So what Fernando's saying is he would take some of this premium here, and then to protect it, where am I, 42 days out? Yeah, sorry about that. He might buy an OTM put and then sell 2 more further OTM as a bear put debit spread. Or buy 1 strike out of the money and sell 2. So I'm going a little bit deeper. It's a bear put debit spread, 1 out of the money, 2 more OTM. So in this case, it's going to cost me 67 cents off of that maximum profit. But now there's a little hedge here. If it falls down to 90 and 85, we have this little cap, and then it exceeds going further on. Yeah, if you're doing a ratio spread, Fernando, that's getting a little bit too much on this. I don't know if that's going to be valid in this case. So in any way, that's my answer, Zhor, there to that situation, and that's my opinion. Okay, I tend not to use that new premium to look at something along those lines there. In that case, to do it in that fashion, I wait until the position already expired, worthless, and I know I've pocketed the money, or I don't have to pay any more money out to close the position. So I've realized the full 595, and then I'll put that back into my cash on hand for the new positions going forward. Let's go back very quickly to the naked put screen. And I believe for our previous conversation for Zhor, I was looking at one that's probably not going to come. Oh, there it is, Roblox. All right, and let's go to the profit and loss chart. So, Zhor, what Fernando was saying in a means to protect the position, you took in 595, but he's saying what he would do is buy, essentially what he means is he buys 1 contract of a lower strike put and then sell 1 contract at the lower strike to create an out of the money bear put debit, and then sell 2 contracts at a lower strike. Now, Fernando, I don't know if you mean in addition to the original put that was sold, because now we're changing a 1-leg trade into a 5-leg position. And that's a bit much. So I don't know if you meant that your initial naked put would have been selling the 2 positions here. Okay, so if he was going, okay, so wow, this is already getting confusing, Fernando. Let's go this way. Fernando was saying that if he made up his mind, I guess what you're saying, Fernando, is that you would have. Okay, let's say in your example, he says, buy one contract of a 160 put, sell one contract of a 155 on Apple, and then sell two Apples at 145 at a lower strike. So I guess in that example, this would be the original, this would be the one strike I was going to sell akin to your 155, the stock at 115. So now I'd be buying, I'm in January. I'm not in January. I'm sorry, everyone. I'm not in January here. Sam, I just selected the wrong January. Okay. Buy a 110, sell a 105, and then two strikes below, 155 to 1. Okay. So sell two more here. Okay. So this is the one I would sell. And Fernando says his approach is he'd buy one strike out of the money, sell one lower strike, and then sell two further or two strikes out of the money from that one that was originally sold. Okay. I don't even know what this looks like. There we go. Okay, so now this is sort of a wide breadth. I don't want to call it a half butterfly, but it's a wide breadth exposure. It really increases the monetary requirement on the position, but that's a very far to the downside. What he did is extend the break even really far down in price. So if we had sold our 105 for 595, our break even would have been around 99 something, right? Close to it. 99.10 or whatever it is. So this structure here, buying one, selling two, buying one and selling one. There's your Bear Put Debit Spread, and selling two further out of the monies. I've got to cover the monetary requirement for these two at 95 strike now. So that's why the monetary requirement goes up from 10,500 up to 19,000. You're still receiving a credit. So if the stock does stay above 110 in this case, everything expires worthless and you keep 389 versus the 595 for doing the one contract with a 10,500 obligation. The breadth is lowered, so the break even is now 90.55. You don't make as much if the stock stays above 110. If it falls into this range, 110 to 107, you're still making a profit. And the sweet spot here, just like an iron condor position, is if the stock's trading between the 105 puts sold in the Bear Put Debit Spread and the 295 strikes that were sold as the additional naked put positions. Okay, so higher monetary requirement, lower return if the stock does as you initially expected to move up in price. We're looking at a 6% return versus about a 4.8% return. The credit up front is less than just the cash secured naked put we were looking at. The maximum profit is potentially more if the stock falls into this range between 105 and 95, which would have been, well, below 100 would have been a loss on just the 105 naked put by itself. So it's increasing the profit because you're getting the full benefit of the Bear Put Debit Spread and the premium of the 295 short puts. There is a higher maximum risk, of course, but we've drastically lowered the break even, so the risk into the thousands doesn't occur unless we're dropping below 85. Let's see where it goes to. It's probably 85, 84. Whoops, let's clear that up first. There we go. So yeah, down to 55, 60 or $6,000 loss, so on and so forth. It's about, where did I say? It's 85, it's about 1,000, 80, yeah, 2,300, 2,100 in that case. Okay, so that's sort of a different approach there that gives you a little bit less up front if the stock does what you initially expected for the naked put position. The benefit for higher profit if it goes against you and stays within this range where your naked put might have been at a loss, a much lower break even so that you have more room before you actually start losing money on the position. So that's an offering from Fernando there in that case. his approach to what he was doing, sort of combining a bear put debit spread and then chew further out of the money naked put positions in the structure. Kind of intriguing. But again, you take less up front if the stock did initially what you wanted to. You have a wider breadth of protection in this place. And you could still make a higher profit if it's trading within those ranges, which you initially didn't expect it to be doing. You expected the stock to stay the same or move up in price in that case when you first opened the position as the strategy itself.